One of the biggest lenders to the United States, quietly heading toward an economic cliff, is not China. It is Japan, the most overlooked financial time bomb in the global economy. With over $1 trillion in United States Treasuries and more than $3 trillion in foreign assets, Japan's next move could shake global markets. And the signs of this potential shock are already flashing bright red. Welcome to the channel that makes global markets make sense. If you are new here, we simplify complex global financial stories like no one else. Crisp, clear, and brutally honest. So subscribe now, hit the bell icon, and let's dive into one of the most important economic stories of this decade. You might be wondering, why should we in India care about Japan? It is far away, rarely in the news, and seems too quiet to cause a global financial quake. But Japan is not just another country. It is the largest foreign creditor to the United States, holding more than $1 trillion in US Treasuries as of 2025. Japanese financial institutions are also deeply invested in American stocks, corporate bonds, and even real estate. So, if Japan faces an economic storm and starts pulling money back, the ripple effects would not just reach Wall Street, they would hit global markets, including India. And right now, Japan is facing something far worse than a storm. Recently, Japan's economy shrank by 0.7%, the first contraction in over a year. That's bad news on its own. But it gets worse. Economists now expect another quarter of negative growth, which would officially put Japan into a technical recession. But this is not just a temporary downturn. It is a symptom of something deeper, a demographic and financial crisis that has been building for years. Japan's population has been declining for 15 consecutive years. Fewer people are marrying. Even fewer are having children. Its fertility rate has dropped to 1.15, the lowest since records began in 1947. Keep in mind, a stable population requires a fertility rate of about 2.1. By the year 2050, Japan is expected to lose 20 million people, about 16% of its current population. And by the end of this century, more than half the population could disappear. That's the equivalent of the entire state of Florida vanishing now, and most of the eastern United States disappearing later. And Japan is not just shrinking, it is also aging. Today, about 30% of its people are above the age of 65. That means fewer workers, less economic growth, and more pressure on healthcare and pensions. It is a crushing burden on the entire economy. So how has the government been managing this slow-motion crisis? By borrowing. A lot. Japan now has the highest debt to GDP ratio in the developed world, over 260%. To keep this mountain of debt under control, Japan followed a familiar strategy. Keep interest rates near zero for years. Why? Because low interest rates meant the government could issue massive amounts of debt without paying much in return. It's like taking a loan with no interest. You can borrow more without feeling the pressure of rising repayments. Then came the second part of the playbook. The Bank of Japan, the country's central bank, stepped in to print money. It used this freshly created money to buy a significant share of government bonds. This kept bond prices high and yields, or interest costs, low. It was a self-financing loop. The government spent freely and the central bank quietly absorbed the cost in the background. And for years, this plan worked. Until it didn't. On Monday, August 5th, 2024, Japan's stock market crashed. The benchmark Nikkei index fell by 12.4%, its worst single-day drop since Black Monday in 1987. The panic started in Tokyo, then spread to Asia, Europe, and finally the United States. Over $5 trillion in global market value was wiped out in just one day. And it wasn't just stocks. Commodities, oil, Bitcoin, everything took a hit. So what triggered this massive meltdown? The answer lies in something called the yen carry trade. Here is how it works. Big global institutions borrow Japanese yen at rock bottom interest rates. They convert that cheap yen into US dollars and invest it in higher yielding American assets. Imagine borrowing 10 million yen at an exchange rate of 100 yen per dollar. That gives you $100,000 to invest. Put that into US Treasury bonds, yielding 4%, and after 1 year, you earn $4,000. If the yen weakens to 105 per dollar, you only need around $95,000 to repay the loan. You've profited from both interest and currency movement. It's like free money. At its peak, Bloomberg estimated that hundreds of billions of dollars were tied up in yen carry trades. Some even called it the global money glitch. But there is a catch. This strategy only works if Japanese interest rates stay low and the yen remains weak. If either condition changes, the trade breaks. And in 2024, that's exactly what happened. After nearly 2 decades of near-zero interest rates, the Bank of Japan finally raised rates from negative territory to 0.25%. This small hike sent the yen soaring 10% within weeks. Suddenly, traders needed more dollars to repay their yen loans than they had initially borrowed. That triggered panic selling across markets. The central bank did not raise rates out of choice. It was forced to do so. With over $8.5 trillion in debt, more than 260% of GDP, even a small interest rate hike is painfully expensive. But Japan's bond investors were demanding higher yields. Auctions were starting to fail. And with the central bank already owning half of all Japanese government bonds, there were no buyers left. If Japan didn't act, its currency would collapse. And that would be a disaster. Why? Because Japan imports over 60% of its food and nearly all of its fossil fuels. A free-falling yen would make those imports expensive. But here's where it gets global. Rising interest rates in Japan make it less attractive to invest abroad, including in US debt. And remember, Japan is America's biggest lender, holding over $1 trillion in treasuries. If Japan starts selling or simply stops buying, America's borrowing costs could skyrocket. In fact, Japan's own finance minister recently hinted that their US bond holdings might be used as leverage in trade negotiations. He later walked that statement back. But the message was clear. In hard times, nothing is off the table. Losing Japan as a creditor would shake America's credit standing, weaken the US dollar, and drive up interest rates across the board. For consumers, that means costlier loans, a paralyzed economy, and possibly a brutal market collapse. When markets crashed on August 5th, 2024, it was clear that Japan's crisis had gone global. And that may have been just the preview. So, what should you take away from all this? Japan's economic troubles are not isolated. They are a warning shot for global investors, governments, and even India. Because in today's interconnected world, when one domino falls, it does not fall alone. If you found this breakdown valuable, hit the like button and subscribe. We decode stories you won't hear anywhere else, and we do it in a language you understand. This is not the end of the story. It may just be the beginning. See you soon in the next video.